Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Carlos Pascual, who is SVP of Global Energy and International Affairs at S&P Global Commodity Insights. Carlos is not only that, but he's previously US Ambassador to Mexico and Ukraine, and also previously US Envoy for International Energy Affairs at the State Department in the US. And I say that because those roles are going to be very relevant, hopefully, to the conversation that we're going to have today. Carlos, you're also going to be presenting at the 31st MPGC conference that's taking place in Dubai between May 20th and 22nd. And that's a conference that is being organized by S&P and hosted by ENOC as well, Emirates National Oil Company. So I'll be attending that myself this week, and look forward to that. But Carlos, let's start to get your thoughts on all things geopolitics, energy, and policy. And thank you again for joining us. Let's start by talking about the situation today in terms of the context of what's happening in Russia, Ukraine, and the Middle East, the two sort of big geopolitical question marks on the stage today, on the energy stage at least. And yet, we've seen energy markets very resilient to that disruption, whether it's physical in shipping here in the Strait of Hormuz, etc., or whether it's infrastructure damage in Russia. How do you explain the resilience this time around of energy markets compared to perhaps previous conflicts?
Well, first of all, thank you for having me. Thank you for the discussion. It's a real pleasure to be here. And I'm looking forward to being back in Dubai in a short period of time. I was last there for COP28. It was certainly a momentous occasion. We're very excited about the conference that we're going to be holding there. It's not COP28, but I think it'll be very significant about issues of trading and markets. And the question that you ask really gets at that question of what's happening in markets right now that's creating as much resiliency as we've seen, despite the fact that we've had a tremendous amount of volatility in global geopolitics. And the fundamental answer has to be production. What we're seeing today is that the production that is coming from the non-OPEC plus countries, so the United States, Guyana, Brazil, Canada in particular, the growth in production is actually from those countries is exceeding the global growth in demand. And that fundamental relationship between supply and demand is what has been a prevailing factor in markets today. That's not to say that geopolitical events don't have an impact. When we saw the heightening of the tensions in the Middle East, we saw a spike in prices. There was concern that they could go up to $100 a barrel again. When we saw what happened on October 7th, there was another spike in prices. These aren't surprising because the marketplace begins to ask what's going to happen, what kind of disruptions might occur. But what we've seen is that once we've gone through the immediate political crisis, if there is a pathway to some form of stability or continuity, or at least not a worsening of the crisis, because we certainly don't have a pathway to resolution of the situation in the Middle East. But that basic relationship between supply and demand is telling us that the marketplace is well supplied. And as a result of that, it's maintained prices on a relatively consistent price band between $75 and $85 a barrel. That's, I think, a good news for the marketplace. It's a good news for consumers. It's also important for investors because they're seeing that there is a price that encourages investment, but one that hasn't been directly contributing to demand destruction. And that combination of factors is one that has been relatively constructive for oil markets. Obviously, we would prefer to have a calmer international environment. We don't want to see the conflict in the Middle East. We don't want to see the conflict in Ukraine, but at least we've got an oil market situation that's provided for some element of stability.
Okay, great. And I mean, you mentioned non-OPEC supply that's increasing as time goes on. And of course, the other side of the equation is demand. We may touch on that later, but I just want to stick to supply for now because you mentioned that. I want to get your thoughts also on where you think US production is going to go this year. But before that, let me ask you about the other element of supply, which is OPEC countries and OPEC plus. That includes Russia. Of course, I don't want to get too deep into that, but they've cut their volumes, haven't they? And that's why we're seeing prices where they are. Everyone says if they had not cut volumes, we wouldn't see prices at this healthy level for producers, at least. Do you see, I mean, from a geopolitical relationship angle, do you see OPEC finding this non-OPEC supply a challenge in terms of market share, or are they happy with this medium and balance that they have essentially helped to create the last couple of years?
I'm not going to venture into trying to predict what the decisions of OPEC and the OPEC Plus are going to be, of where their comfort levels lie. That's inevitably going to be a result of the discussion among the ministers that will take place quite soon. What I can say is that we have a very robust situation for production outside of the OPEC and OPEC Plus countries. And the United States right now, producing at over 13 million barrels a day, is producing more oil than any other country that has ever been produced in history. It's quite astonishing. And there are often rumors in the context of an election in the United States that American production is lagging. It's not lagging. What we're demonstrating is that the conditions exist in the United States to create sufficient certainty and security for investors that they're investing and that they're producing. And obviously the prices internationally are attractive. That's part of why it's happening. But we've also seen tremendous resiliency in other parts of the world. I was recently in Guyana. I was quite struck by the efforts that they've pulled together to continue to streamline the process of approving production, bringing more barrels online. I was recently in Brazil and have talked to the Brazilian experts. Even though there are changes in management in Brazil and Petrobras, there's still a very clear path forward on how both Petrobras and its partners are continuing to invest in Brazil and within Brazil. In Canada, again, I was recently there as well, and the trend is one that has been quite positive and responsive to the international environment. So I think that what we're seeing right now on the part of the international community is responding to market signals, and at the same time, lessons that have been learned in the politics, policies, and regulations that have made it possible for companies, private companies, and national oil companies to be able to invest and be prosperous.
Okay, I mean, talking about policy, I mean, I just want to touch on Mexico because you have obviously a background in that and you're ambassador to the country. Just talk about their energy sector, just in the context of we have elections coming up. It will be a female president ultimately who wins. Do you see any, again, that sector has had its challenges in Mexico for different reasons. Do you see any change, any positive outcome coming from a new government in Mexico and to it overcoming some of the challenges in that sector?
In fact, I live in Mexico. I see the politics around me all the time. The issues on the energy sector are probably the ones that are maybe least dramatic in this election process. Pemex is a mainstay of the Mexican energy environment. Pemex is going to be continue as a key player within Mexico. One of the issues will be whether there are possibilities that are created to bring private sector investment back into Mexico, whether there may be a reopening of the bid rounds. This is one of the major issues that is a difference between the two candidates. As you've indicated, both candidates most likely to win the election. There's a third candidate, but trailing far behind. So most likely it will be a woman president that will be the next president of Mexico. That election will take place on June 2nd. We'll know soon after that. One of the candidates has focused more on continued development of both oil and gas and electricity resources with state-owned entities. The other candidate has indicated an interest of both maintaining the state-owned entities, but creating greater possibilities for private investment. We won't have to speculate on this too much if we wait a couple of weeks, because at that point we'll actually see what the elections are, and we'll have much more clarity on the direction that Mexican policy might take.
Okay, great, great. Carlos, I wanted to ask you about, let's go back to US energy, but not so much about the production that is happening there and what levels it's reached and that future, but more about its external policy with regards to energy and geopolitics. Can you touch a bit on your expectations for the Venezuelan angle? Obviously we saw the reprieve on licensing there. We did not see that technically renewed. And however, commentators in the market say that we're still going to kind of see, the likes of Chevron continue to produce. There is interest for even newcomers to come into the Venezuelan oil sector. Have we turned a tide in that, do you think, having seen that reprieve from the US? Is it in the US's interest to, in time, continue with that slightly softer policy?
I had an opportunity to have discussions with people in the administration about this. One fundamental point which drove the decision to not continue the license that was previously issued for Venezuela was that the commitment that was made on the part of the Venezuelan government and President Maduro was to have free and fair elections. And given the lack of transparency on what candidates were allowed to run, the leading candidate on the part of the opposition who was disqualified, that led the administration to make the choice that they were not extending the license. At the same time, the administration wanted to send the signal that they want to be able to entertain the possibility of giving individual licenses at the request of individual companies. They've made that very clear when they made their announcement. They continued behind that stance. And so part of what they're trying to suggest is that they want to create the possibility for continuing some form of energy relationship with Venezuela. Mm-hmm. There's a recognition that if elections take place and those elections do present an opportunity for real competition, that if there can be a scenario for Venezuela that allows more resources to get back to the country and filter down to the people of Venezuela, where there has been a very significant impact on both poverty and access to capital to be able to create any kind of bottom-up development internally within the economy, that type of bottom-up entrepreneurship would be a positive thing to be able to see. And so the administration has created the framework that would allow some possibility on a case-by-case basis on requests for individual licenses. And we'll see how this continues. Much of it depends and rests in the hands of Venezuela and what kind of actions they take during the election process.
Okay, but of course, the other election that we have coming up is the US election at the end of this year in November. I mean, both candidates quite, I suppose, transparent about what their energy policy is at the moment in terms of Biden, and we saw what Trump did last time. Do you foresee any changes to the status quo? We have, for example, existing sanctions led by the US on Russia. We have Iranian sanctions, which haven't seemed to have been very strict in the last 12 months. Do you see that any difference to the outcome of the US election impacting flows of oil, essentially, in reality and practically speaking?
The two candidates, President Biden, former President Donald Trump, have been clear about some aspects of their energy policy, and others remain a bit more uncertain. The area where there is the biggest clear difference is related to Russia and Ukraine. President Biden has been very clear on condemning Russia's invasion of Ukraine and defending Ukraine's right to its territorial integrity and national sovereignty. Donald Trump has indicated that continuing significant support for Ukraine, particularly military assistance, is not in the national interest of the United States. That is one area that may be the most striking contrast, and what impact that might actually have on energy markets, it's unclear. But one of the things that we have to be recognized is that at the point in time when the United States had a pause, had stalled on its allocation of military assistance to Ukraine, the Ukrainians used whatever means that they had to be able to defend themselves and to attack. They were short on missiles for missile defense. They were very vulnerable. They were short on artillery. And one of the things that they had been able to develop are sea drones that gave them the ability to take out 900,000 barrels a day of refining capacity in Russia. Would Ukraine return to something like that if there was a situation where assistance was cut off? I think it's inevitable that the Ukrainians would be looking for every kind of mechanism to defend themselves and to advance their interest and to gain leverage if there were negotiations to develop at some point in time. On Iran, the issues are much broader, and the recent conflicts that we've seen directly between Israel and Iran have been game changers. I think one of the situations that everybody is trying to look for, and the administration is certainly, the US administration is trying to make clear, is that on the issue of Iranian attacks on Israel, that the United States would stand for the protection of Israel, and that attacks on the part of Iran would not be tolerated. And I think that what we've seen throughout the region in most countries is a recognition, even from Arab states, that toning down and moving away from that direct kind of confrontation is in everybody's interest. How that will play into energy markets remains not completely clear, but I think this point is important to take into account. The principal client for oil that is coming out of the Strait of Hormuz and the Gulf is China. And Iran has a fundamental interest in those resources getting to China because of their relationship with China, China being a critical and key customer, and China being an investor directly within Iran. It's also important to recognize that China's strongest relationship in the Middle East is with Saudi Arabia, and that relationship will continue to grow. The levels of investment of China and Saudi Arabia and vice versa are extraordinary. Particularly in the petrochemical sector, that is a long-term relationship that is not going to be disrupted. I think those are going to be counterbalancing factors around the general sense of instability related to oil. Iran has an interest in the Gulf being an area that can continue to ship. Saudi Arabia has an interest. China has an interest. And that combination of factors is probably going to maintain some degree of stability in what we see around oil markets.
Yeah, I mean, we certainly seem to see the sort of multipolarity equation that used to be shifting significantly. And it's very much today about protecting supply chain and just making sure everything works. And countries like Saudi Arabia can have great relationships with China and good relationships with the US. And those interests, whether you look at that example or others, just don't seem to be clashing anymore. But let's just talk a bit about the US and China and the trade skirmishes, let's say, that they're having, not necessarily on energy, but of course, on tech. You've got the TikTok ban. We've had Biden impose the 100% tariff on importing EVs from China. We saw another tariff suggested by him today about solar panels, again, protecting domestic US industry, IRA bill, etc. He's being, it's ahead of the election. We're seeing these announcements come out, but give me your take on the US's commitment to clean energy tech and Biden's rather confusing policy towards the energy industry, right? I mean, he's campaigning on one thing, and yet and the licensing on traditional conventional oil and gas seems to be flip-flopping a bit. Does the market have a clear reading of what that policy is going to be?
I think the marketplace has a much clearer reading than is generally given credit for. If the United States is producing 13.2 million barrels of oil a day, more than ever in history, it's not because they think that there's uncertainty in the marketplace and because they're confused. It's because they think that they can make investments that have a 20-year lifespan and that there's an environment to productively be able to invest resources to be able to generate that kind of production. On the issue of renewable energies, I think this is really important because it's one that is much more stable than I think people generally think on the surface. The choice that the United States has made with the Inflation Reduction Act, but also the bipartisan infrastructure law, the CHIPS Act, is that it's investing in subsidies in order to be able to create American productive capacity in clean energy technologies and information technologies. So we see that on wind and solar and batteries and electric vehicles, on carbon capture, on hydrogen, on nuclear, right? We see it as well in the development of semiconductors, which is particularly critical in the relationship with China. The US is doing it in embarking, as increasingly American officials, US officials are saying, as a part of an industrial strategy, partly focused on energy, but focused on energy for the purpose of creating a new manufacturing and productive capability in the United States. So when you think of it from that perspective, if the United States is investing, I'm going to use the number trillions of dollars in this area, it is not looking forward to the possibility that it invests trillions of dollars, and at the end of it, that Chinese products that have been subsidized can be competitive and undo the value of that benefit, right? The reason that I'm saying trillions of dollars is that the Inflation Reduction Act was created principally around the concept of tax incentives. Those tax incentives are based on investments. The higher that investments increase, the more that the tax incentives go up. So originally, when the Inflation Reduction Act was estimated, the estimate was about $390 billion worth of investment in investment on the part of the government through those tax incentives. And just the first year, the level of investment in eligible renewable technologies was $320 billion in just the first year. So the expectation is that the investment that will be coming on the part of the United States in clean technologies will go into the trillions of dollars. Final point, let me just make here, if you or bear with 1 minute. When one looks at the states and the businesses that are the principal beneficiaries on solar, wind, batteries, electric vehicles, carbon capture, hydrogen, the majority of those states are either Republican states or what are called swing states in the US election process. It's changing the dynamic of politics in the United States, where traditionally Republican states now have a self-interest. The companies in those states have a self-interest in seeing the continuing flow of the resources and the subsidies from the Inflation Reduction Act going into clean technology. That's going to have an impact going into the future. And one can expect that the interest of those states is going to continue, whether it's a Biden administration or a Trump administration. And I think this will be a very interesting thing to look at what happens on US policy relative to investments in clean technology going ahead into the future, because this is no longer just seen as an issue of climate change. It's now seen as an issue of national security and industrial competitiveness. It puts it on a completely different playing field. For those who have doubts about where US policy may go, it's going to be driven more by national security and industrial strategy than potentially driven by the issue of climate change.
Yeah, and on the other side of the equation, you have China, which is doing similar things for the same reasons as well. I mean, this sort of, again, this self-reliance, this nearshoring on every level is obviously taken off a lot for many different reasons. Carlos, I want to ask you about the transition away. I mean, we're talking about new clean energy technologies, and we talked simultaneously about healthy US oil production. Give us your take on the challenge, perhaps today, of the energy transition. Yes, we're running both in parallel. There's agreement that has to continue, but how do you see that dynamic balance shifting? Debates over peak oil demand, etc. Are countries taking the right policies, and do we have to all be in agreement, if you like, or can we have regions and individual countries pacing that transition as they wish?
It's an excellent question. I think it's going to be one of the most significant issues that gets debated over the course of the year and possibly for many years, and it's going to be a critical factor in COP29 as well. The most dramatic moment at COP28 was that final day of being able to reach that consensus among all of the participants on language that said a transition away from fossil fuels in a way that is consistent with the science, but also recognizes the multi-dimensional nature of this issue, the differentiated resources on the part of states. And the question becomes how to make that happen. One of the things that we know is that it's a huge challenge. The goal, the target that was set from COP28 for 2030 for a reduction of 43% of CO2 emissions by 2030 is beyond even the most optimistic scenarios that companies like S&P Global and others have developed looking forward to the future. This is leading to a debate, in some cases a clash. There are some who look at this and say that we're behind, so we need to accelerate, we need to go faster. There are others that look at it and their reaction is that is so far away from what I think I can realistically do that I'm not going to move at all. And those are the extremes. And in the middle, we have to figure out how do we address this reality where there are limits in effect of a carbon budget of how much carbon the world could absorb in order to be able to still redress the worst impact of climate change. And if the target is 1.5 degrees centigrade, that carbon budget is even tighter. If it's 2 degrees, it's a little bit looser, but even that is a challenge right now. When we look at what happened between 1990 and 2022, the world's primary demand dependence on fossil fuels decreased from 82% to 80%, a 2% difference when $6 trillion were invested in renewable energy, which principally went to meet increasing demand. It shows how difficult it is. Technologies are emerging, they're advancing, they're going faster. Artificial intelligence will allow some of those advancements to go even faster. But this will be a tremendous challenge where innovation and technology are going to be key. And the issue and the challenge for the international community is, can we look at this in a way that recognizes the reality of different countries with different income levels, different resources that will be going at different paces, the fact that we need to do everything possible to innovate as quickly as we can and to share those innovations, the importance of bringing in private investment in order to be able to support that. Those are the challenges that we have right now. How to bring that together in a package that's going to work perfectly, we don't have that right now. That's the challenge that we have. How to work on this to be able to make it functional, viable, and commercial, not just to step away from it and say, this is impossible to do, but to say, look, there are realities here in climate change that we're dealing with. So how do we come together and bring all of our capabilities, technological, economic, commercial, the very capacity to operate at scale and the diplomatic capabilities that are necessary. And it's one of the reasons why we continue to say it's necessary for industry to participate because they have the engineering skill, the technology skill, the ability to be able to operate at scale. And at the same time, it's critical to have a political and diplomatic understanding. And we need the private sector to come in as a critical finance component into this equation. All of that is part of what we have to be able to manage and make succeed to get us to what we want to have, a prosperous world, energy security, energy affordability, energy sustainability, and competitiveness at the same time. That's what we're trying to achieve and to come together on in a very challenging environment.
Absolutely. And of course, one of those challenges you touched on is recognizing that not one size fits all. You've got the whole emerging market and you've got Africa and you've got continents that can't possibly do what others are doing in terms of investment. And I suppose diplomacy will be probably the solution that'll drive us forward as well. Carlos Pascual, unfortunately, we've run out of time. We could have gone on. Senior Vice President of Global Energy and International Affairs at S&P Global Commodity Insights. We look forward to hearing more from you at the MPGC conference. And thank you again for joining us on Halftime Talk.
A real pleasure. Look forward to seeing you in Dubai.